Welcome to the Purpose-Based Retirement with certified financial planner Casey Weade. Casey is the president of Howard Bailey Financial.
Whatever risk you face during your retirement years, we've got a plan.
A published author and radio host.
It's not how much we make during the good times, it's how much we keep during those really bad times.
His advocacy for retirees and pre-retirees has made him a sought-after speaker and trusted financial leader.
And putting a real plan together.
This is the Purpose-Based Retirement.
Hello and good to see you again. I am Lee Kelso here with Marshall Johnson and Casey Weade, certified financial planners from Howard Bailey Financial. We're going to start the program today talking about life insurance, and no, it's not what you think. Many people pay a lot of attention to life insurance in their younger years, but what role can it play in retirement? It might just surprise you what we have to say. We're also going to take a look at exactly what is a hybrid long-term care policy. So kind of a retirement insurance focus today, but one I think is vital if you're heading toward retirement, if you're in that retirement red zone like me. So I hope you'll stay tuned. Casey, let's start off with that whole point. Did I surprise people there thinking that insurance is an important vehicle in retirement?
Right. Well, I wanted to bring an article that I found on Forbes. I write for Forbes and Kiplinger, and anytime I sit down to do my writing, I sift around other articles, and I want to see what's out there right now, and what are people talking about, what are other people writing about. And what I often see is pundits that are beating up life insurance, saying, well, take term, invest the rest, all whole life is bad, or all cash value life insurance is bad, index universal life, variable universal life. And there's always these biases out there, and I don't feel like they typically cover the right parts. I might even be proponents, or they might talk in support of utilizing life insurance, but it's simply to protect your income from your family or pay off debts in the case of your timely death, your funeral expenses. And I just found this article to be very interesting. And the article in Forbes, written by Jamie Hopkins, was titled, "Why Life Insurance is Essential for Retirement Planning." And it goes on to discuss how it can help protect your income, provide tax-free cash flow, help manage taxes, provide peace of mind to families, and even improve total returns in your portfolio. And what I liked about this is that I'm almost employing, if not all, at least 3 or 4 out of these individual things in my own family's finances. And I think it's always nice when you can see and talk to a financial planner that's actually implementing the strategies he's recommending in his own life. And I can share with you some stories about how we're doing that in our plans that we're putting together, as well as my own family's life.
So how do we protect income in retirement with life insurance?
Well, I think a quote that was listed in the article was really interesting. It was by James Meehan. He said, "You can't invest your way out of an untimely death." And I think that makes a lot of sense. We can't invest our way out of an untimely death, because if we aren't totally invested, let's say you had $500,000 and you needed $20,000 a year in income to support your lifestyle and that of your spouse. Now you've got another, say, $20,000 each. Let's call it roughly $20,000 each in Social Security. So you've got $40,000 Social Security, $20,000 in portfolio income, and now one of the two spouses dies. Now you lose a third of your income. $20,000 is now gone because you're going to lose one of those two Social Security benefits, the larger of the two. Mm-hmm. And are your spouse's expenses going to go down by 30+%? Most likely not. It's typically only 15 or 20%. At the very most, we see expenses go down. And it's not just Social Security. It might be your pension, but one thing that's so often overlooked is taxes. Right. What about your tax brackets? Now, if you're going from a marrying filing jointly situation to a single filer, not only did you take a hit on your Social Security, maybe even a pension, but now you may be paying an extra 10% a year in taxes at the same time. So now that 30% loss turned into a 40% loss. This is why it doesn't always just make sense to carry life insurance during your working years. It makes sense to protect your spouse during your retirement years as well.
Yeah, because it's about protecting that income. And I think you make an interesting point, because most people don't think about what is that case when my spouse passes away. They may realize that they get to keep the higher of the two Social Security checks, but really looking down and looking at that budget, Casey, there's a lot of things that those expenses are still still going to be there. You still got to pay for the house, the property taxes, you still got the utilities. You still have a lot of those bills, regardless of whether there's one spouse or two. So you make a wonderful point about covering those expenses.
You know, and we can get very creative in this respect at the same time, especially if you have a pension and you're trying to protect that pension for retirement. I had a couple that worked at a local defense contractor here in town. They had very large pensions that they had the ability to take a lump sum, a single life, or a joint life option. We ended up taking the single life option and using the difference between the single life and the joint life to guarantee that if something happened to one of the two of them, they'd be leaving assets behind to the next generation, not just to each other. And that was something there was one of their biggest concerns, was we want to make sure that this pension that we have, all that hard work, doesn't just go up in flames if both of us pass away. And this ensured using several, we used 5, 10, 15, 20, 25-year policies. We used a lot of different policies with several different companies in order to make this work, stay diversified, and meet their goals.
How can life insurance help keep my retirement savings on track?
Yeah, I think that's an important one. I unfortunately just had to deal with this situation just recently where a widow came to see us and her husband just passed away, and he was 61 years old. They were 5 years from retirement, planning on retiring at 66, and it came at a very difficult time because this is when they were in their peak earning years and really needed those next 6 years to be able to sock away enough for retirement. So she was really in a bind. Thankfully, he did have some life insurance that was going to be able to keep her from a very difficult situation.
Sure, and I think if you're buying life insurance, if you're buying a 5 or 10-year term policy, it's incredibly cheap and inexpensive. In order to make sure you have that coverage right before you get to retirement, make sure it's convertible. Just like I did with my dad, we did a convertible term policy, and by the time he got to be 60, his health wasn't nearly as good as it was 5 years prior, and so we knew, well, we have to convert this to a permanent policy, and so we were able to convert all those premiums to reduce future premiums. So just something to think about as you're implementing these strategies.
Managing taxes is something we always need to be thinking about. And what role does insurance play there?
Well, Tom Hagna was quoted in this article, in this Forbes article, and he's a host of the popular PBS TV special, actually, Don't Worry, Retire Happy. And he suggested positioning life insurance as a substitute for bonds in a retirement income portfolio. Quoted as saying, right now, bonds have very little upside. They're only paying in the 1% to 3% range, yet the risk of holding bonds is very high. If interest rates rise, the downside risk to bonds could be 20 to 30% or more.
Wow, yeah, good point.
And that is the case. Whether it's whole life or indexed life, we can earn bond-like returns without the interest rate and default risk that we find with bonds. But now we're putting that risk on the insurance company, which is backed by their own legal reserve system. I don't think it makes sense to take all of our fixed income away and do this, but taking a portion and diversifying away from just those Wall Street investments does make a lot of sense.
Well, with interest rates where they are today, Casey, we have to look outside of the box. We have to be aware of these strategies. I think when you start talking about life insurance, a lot of people go, oh, geez, everybody's tried to sell me that for the last 30 years. Sure. But because of the tax code and because of the environment we're in with low interest rates, there are some opportunities.
Well, the last one was managing your taxes. And I think, for me, this is one of the biggest benefits of life insurance that we've implemented in our own financial lives. And who is quoted here is Russ DeLibero. He holds a PhD in financial and retirement planning. He's a doctorate in financial planning. Is your advisor a doctor? I'm not a doctor in financial planning, and so I think we have to listen when people like this talk. He was quoted as saying, when properly structured, life insurance can provide tax-deferred growth, tax-free cash flow, and a tax-free death benefit, and a non-correlated asset to the portfolio, offering additional diversification. I've been doing this and saving in this way since 2008, and I have been able to see better returns than many people have seen in the market without any market risk in my accounts that now I'm going to be able to use tax-free in the future, max out my Roth, then use that. Yeah. Life insurance isn't the first step when you start saving for retirement. Right. You should be insuring a major risk that you have and then saying, okay, it's also going to allow me to build some cash value at the same time. And hopefully you already funded your Roth, you already funded your 401k and got your match, your HSA. This is not the first step, but it is a valuable one.
All right. We have to leave it there and move ahead. If you'd like to learn more about the topics we've been discussing here today and ensure you're 100% prepared for your retirement future, visit the website, thepurposebased.retirement.com, where you can pick up a free copy of Casey's latest book, The Purpose-Based Retirement, or you can get a copy of his 2017 guide to maximizing retirement efficiency. It'll uncover action steps that you can take this year to make 2017 your best year ever. Again, that's purposebasedretirement.com. Always feel free to give the team at Howard Bailey a call with any specific questions you may have. The number's on your screen. We'll be right back in just a second.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation?
Will you be there for my ball games?
Will you teach me your values? You'll be able to play with me.
Oh, help me go to college. How will I remember you?
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
Time for us to answer your questions. During the week, people contact the Howard Bailey with questions, and we pull a few of those folks out and ask them to join us here on the program. Larry is one of them. He's over in Huntington. Larry, go right ahead.
My broker has underperformed the stock market for years, so I'm not sure why I even need one anymore. I'm about to liquidate my mutual funds and throw it all in index funds. Do you make these kinds of recommendations?
Boy, Larry, fire your broker? Occasionally, we have to do that. I really appreciate your question. I think it does take some deeper thinking into why are you seeing this underperformance, and we do recommend that people move into index funds, away from actively managed mutual funds and things like that, but it's for their very long-term money, and that's what you have to understand. Your broker may be underperforming the market because they're managing your portfolio more conservatively than the broader stock market index. You're looking at the S&P 500. That's one type of equity in one demographic region in the world. There's the Russell 2000. You've got index funds that are all over the world. Are you using the right benchmark for your portfolio? I think that's the first thing to ask, because you wouldn't want to invest if you're in retirement. You wouldn't want to throw everything in the S&P 500 and just ride the wave. Most likely you couldn't afford that type of risk, so you may be in a more conservative portfolio, and that might be why you're underperforming. Now, if you're underperforming, let's say you're making 5% while the S&P is making 7%, you better not be taking on as much risk as the S&P 500 in order to get that 5%. Because I had a couple the other day, for instance, they said we're okay making 4 to 6%. We don't need to outperform the market or even do as good as the market. We just don't want to lose as much as the market in the bad years. And when we stress tested their portfolio, we found that yes, they were underperforming the market by about 2 or 3 percentage points a year. And they said that's fine. I don't mind making 4 or 5%. But when we looked at the worst case scenario, they could lose over 40% in another 2008 because a large portion was allocated to fixed income and high-risk fixed income. You have to really understand what's going on and really the molecular biology of your portfolio. And that takes bringing it in and getting it audited and trying to figure out what's really going on.
Yeah, it sure sounds like they need a stress test there. It sounds like there's some inefficiencies. What are the expectations? We talk a lot about return expectations. How much are we looking for? What do we need? What is your required rate of return? Those are all things that we would want to work with you to understand going forward, so you know you're taking the prudent amount of risk.
Index funds make a lot of sense when you're trying to reduce your overall expenses and you have a long time till you need those funds. We will typically use those for our portfolios that we don't need for 10, 20 years out, where we can have more of a buy and hold strategy and have the lowest cost we can possibly have. And if you're young, you're 20 or 30, you're putting money into your 401k or your Roth IRA and you're just trying to save and you're a long ways out from retirement, absolutely buy those index funds, dollar cost average in, and you'll be in great shape. Do that same thing with your entire portfolio in retirement, and you're going to find yourself in trouble.
Thanks for your question, Larry. Let's get over to Ohio, Convoy, Ohio, in fact. And Julie, what's on your mind, Julie?
My husband and I are in disagreement with saving during retirement. He has budgeted 15% of our budget towards our savings account. Should we still be saving during retirement?
Well, Julie, that's a great thing. If you can still save in retirement, it means you're doing something right.
And really, saving's always a good thing.
Yeah,
right?
Saving's a great thing. But, typically in retirement, where it's now about spending and drawing down, we're not in the accumulation stage anymore. But it sounds like you need to have a real honest discussion with your husband about why you're still saving. Would you agree?
Yeah, well, when we talk about saving, I want to make it can have a completely different context when we get into retirement. So what type of money are we saving? Are we taking IRA distributions? distributions and then taking 15% of those IRA distributions and putting away in a savings account, that's not really saving. We're just shifting money from one pocket to the other. Now, during your working years, you're creating additional income. You could either go expense that, you could go out for dinner a few more times every month, or you could be setting that aside for retirement or in a savings account for your emergency account. There are different types of savings. Now, if you're taking money out of an investment account and then saving that portion, that 15%, and setting it aside and saving it, you have to ask yourself, for what? What am I saving for? Because I do often say this, when you're in retirement, you're living on a fixed budget. So you should be saving for future things, future cars. You should be saving for cars. You should be saving for major vacations and trips and things like that. But there has to be a reason for that saving. If you're just saving for the sake of saving 15%, then you might be costing yourself additional taxes and great underperformance and hurting yourself in regards to what's going on in inflation, because now you've got dollars that are earning potentially absolutely nothing. You're safely losing to inflation, as we often say.
So this is where you become something of a retirement relationship counselor as you talk with people, right?
Well, it's about looking at the facts. You know, there's nothing wrong with having a disagreement with your spouse. We all know that. You know, we've had those types of disagreements, and it happens. And when my wife and we have those disagreements, you know, I am the analytical type. You know, I like my spreadsheets, and I'm going to pull those things out, and I want to show her the facts. Well, sometimes I got to let her cool down a little bit before we share the facts. But then that's that opportunity to do that. But I know the numbers, I know the spreadsheets, I know the calculations. So we can open it up and we can say, does this make sense? Where's this going to put us in 10 years? Where's it going to put us in 5 or 15 years? Is this the best thing for us to do, or should we be looking at this another way? And you may not be in a position where you're very comfortable putting together those numbers, and maybe it makes sense to sit down with someone that's a certified financial planner practitioner that can put those numbers together for you. And we do this day in and day out. You know, couples see things in different ways. Sure. If we weren't different when we got married, we wouldn't have a reason for one of the two of us, right? That we need to be a little different, but it takes somebody to sit down and really get into the hard facts to make the best decision for yourself and your family moving forward. And that takes some time. It takes sitting down and getting a real second opinion, and that second opinion can't come from your spouse either.
Well, and you know, as the analytical type, sometimes the non-analytical type
they
get frustrated by the spreadsheets. So be careful with the spreadsheets for you.
That's why you got to hire somebody else to do the spreadsheets.
That's true.
Thanks for your question, Julie. We appreciate it. And who knows, he may be thinking Harley somewhere in the future, and he just hasn't shared that with you yet, too. Well, to learn more about the topics we've been discussing today and ensure that you are 100% more prepared for your retirement future, visit the website, thepurposebasedretirement.com, and you can pick up a free copy of Casey's latest book. It's called The Purpose-Based Retirement, or the copy of the 2017 Guide to Maximizing Retirement Efficiency. It'll help you uncover action steps that you can take this year and make 2017 your best year ever. Again, that's thepurposebasedretirement.com. And as always, you can feel free to give the Howard Bailey office a call with any of your specific concerns. The number is on your screen. Our question of the day: what is the lifetime probability that you're going to need long-term health care if you are 65 or over? Options are on your screen. We have the answer coming up.
Hi, I'm a certified financial planner practitioner. Are you one of the lucky few that will still carry a pension into retirement? Is your company offering you a buyout or a lump sum pension option? If you're seeking independent, unbiased advice from an advisor that can inform you about all of your options, then look no further. You deserve a lifetime of financial confidence due to a lifetime of income. And at Howard Bailey Financial, it's our goal to help you achieve that. If you'd like to see how a CFP professional can best serve you, give us a call today.
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
Going into the break, our question of the day was, what percentage of people are likely to need long-term health care if you're 65 or over? Casey, that's a big number. Which is it?
It is, and it's one of the larger numbers. AARP shares with us that number is 68% of individuals 65 and older will face at least 2 out of 6 disabilities during their retirement years and require some form of long-term health care, whether that's home health care, assisted living, nursing home care. This is a very real risk. It's a bigger risk than having a house fire. It's a bigger risk than getting in a car accident, and we insure against those things. It makes sense to at least have a plan for those things. Even if we don't end up buying a life insurance policy or long-term care policy, we can still have a plan for the worst. And even if we don't end up in putting together any plan for this and you decide to just accept the risk as it is, I think it makes sense to always know what our options are. We're not talking about buying a car here. We're not talking about buying a house here. We're talking about the rest of your life and your entire life savings. Take time and make sure you're making the best decision for yourself moving forward. I had a gentleman that came into our offices, and he came in by himself initially. We're going to call him John because we're going to do a little case study with John. He was studying hybrid long-term care insurance policies. He wanted a long-term care policy, and really his wife, we'll call her Jane, wanted a long-term care policy because she worked at a long-term care facility. And this is what we find so often is we have people that come in that typically work in these facilities and know the devastation that these costs can occur, and they want to put a plan together. And that was the case with Jane. Well, she set John on a mission because Jane was working. John came in to visit with me, and he said, I'm here for not just a second opinion, but I'm here for options. He was presented one option by his broker that had been selling him mutual funds for years and now was trying to help him with some of his long-term care planning. However, John said, I was only presented with one option. John was the engineer type, kind of like myself. He likes to see options. He likes to see many different options side by side, because if he's only presented one option, he would know, how can I possibly make the best decision? How can I know I'm making the best decision if I'm only getting one option? And he got the feeling he was only getting one option because that was the only option his advisor had. So what we did is we shared with him several different options. We set them up side by side so he could make that decision for himself. What he came up with is he came in with a variable universal life policy with a major insurance carrier. This was what was proposed to him. They were having him put $30,000 in a lump sum the first year and paying an $11,622 annual premium for the rest of their lives. Now, again, I think I need to point out 66 and 59, there's a 7-year difference between those two ages, and that's roughly life expectancy. So they could need long-term care and they could pass away at the same time. So it really requires them to have a good policy. For the variable universal life policy, they were a little concerned. They did get $550,000 in death benefit and $550,000 in long-term care benefit. That means if they only use a portion of the long-term care benefit, the remainder passes on as a death benefit. This wasn't the use it or lose it nature of a traditional long-term care policy. However, what they were concerned about was the cash value. So every year, they were investing that $11,000 every single year into this policy, and it was being invested just like a variable annuity. After loads and expenses, it got invested in mutual funds. Now, if the market experienced a downturn or didn't perform very well, then that meant that they could end up paying more premiums in the future. So they didn't have locked-in premiums. They could pay more in the future, even though they could have more cash value in the future. They had that potential. If the market went well, it could be a good investment, but it also could collapse and not be there when they need it most. And for their biggest concerns, they said, we're not concerned with creating an investment. We're not looking for tax-free income in retirement. We just want to know we filled this gap when it comes to long-term care. So we wanted to look at guaranteed solutions. We looked at a guaranteed universal life alternative, paying that same premium up front, that $31,000 in the first year, and an ongoing premium of $10,000 a year. We saved them around $1,500 on an annual basis, so they wouldn't have to pay as much, and they ended up with the same benefits. The downside is they weren't going to create very much cash value, so they wouldn't have very much, if anything, to walk away with down the road in all likelihood. However, they did know their premiums would never increase. They would have that coverage for the rest of their life, regardless of how long they lived. They would have a permanent long-term care policy and a permanent death benefit for the two of them. This is a cash-based policy, so this is going to pay back them in the form of cash, not on a reimbursement basis, which is the way typical long-term care policies are structured. You actually have to have that specific care for them to deliver to you that cash, rather than just being disabled in the form of, say, an accelerated death benefit, as in this case. Well, with the whole life policy structure, we looked at a reimbursement-based policy that would really be focused in on long-term care. We would pay $24,000 the first year and $11,000 every year after that. That saved them $10,000 in the first year. And that created a death benefit that wasn't as large as the other ones. It wasn't $550,000, it was $315,000. However, their long-term care benefit was unlimited. They had a lower death benefit, but $6,500 a month for each of them that would last the rest of their life, even if they drew down the whole $300,000. They could both be in a facility simultaneously. It would pay out $13,000 a month for the rest of their lives as long as they needed that care. And what we ultimately ended up going with was a combination of these different options. They didn't like the cash value and the risk of the variable universal life, but we did do a combination of the guaranteed universal life, buying one on each of them and having some permanent coverage in force in regards to the whole life, offering them some additional flexibility in how they get those benefits. They've got both cash basis benefits and reimbursement based benefits. They've got death benefits that pass when the first one passes away, when the second one passes away. Got some unlimited benefits and some limited benefits. I think it makes sense to diversify no matter what we're doing. Are you buying long-term care coverage? Are you getting yourself a life insurance policy? Are you investing in ETFs and stocks and mutual funds and bonds and annuities? Whatever it is, you diversify. And that's what we did here with their long-term care solution.
So in that scenario, I'm putting myself into that picture and saying those ages are kind of close. So that gives me some idea of what kind of rates I might be paying, unless I have health conditions. Were those both very healthy people?
They were relatively healthy, so they had high blood pressure, cholesterol, some of the basic, things that many people have. One of them had was diabetic, but it wasn't a severe form. It was under control. So those things are still manageable. And this is about the age that we can possibly find solutions for those problems. Many times I'll go through this process and we never implement any of these solutions, but at least we know our options. So, and how much older can I be before that type of care is or that type of insurance is too expensive and not practical? Well, you can get benefits all the way up to about 85, or I've seen them get closer to even 90 before. However, the benefits just get smaller and smaller the older you get, and you have to look at different types of solutions. You're not going to get a traditional long-term care insurance policy when you're 85 or 90 years old. It's just not going to happen. It's just going to be too expensive. But some of these hybrid solutions, that's where they come into play in some of those higher ages. You just don't get as much of a benefit.
And so what is the right age to start making that decision and looking at those products?
Well, I started looking at those things when I was 25. I started, 23 actually. I started looking into what different solutions, but when I was 25, I was finally married and we were starting to have kids. And we said, well, now this is the time it really makes sense to put in some disability benefits and have some long-term care solutions. And so we started looking into those solutions, at a very young age, and that's very unusual, right? And I wouldn't say that's right for everybody, but if it were me, I know when my kids get to be 20, 30, 40, I hope that they're always looking into what their financial options are. They're always educating themselves on what's out there so that they can always be making the best decision for themselves and their families, because I love them.
And that's what we want to happen for you as well. So if you'd like to learn more about anything we've talked about today, make sure you are prepared for your future. You can visit the website, The Purpose-Based Retirement, and pick up a free copy of Casey's book. Or you can also pick up the 2017 Guide to Maximizing Retirement Efficiency. And it'll uncover some action steps you can take right now to make 2017 your best year ever. Again, that's at thepurposebasedretirement.com, and you can always feel free to give Howard Bailey a call for any specific questions or concerns you may have. The number's on your screen. We'll see you next week.